Hey everybody, it's Lawrence here from financialthing.com for your almost always weekly Thursday live stream here on YouTube. Welcome to everyone. Thank you for joining me and to all your fellow investors. We're going to talk about this week's peer-to-peer lending investment news as always. Coming to you today, still from a very rainy and stormy Florida. If you hear loud bangs in the background, it's because there is currently a nasty thunderstorm going on outside. So if for some reason I lose power, you'll know what happened to me. It's not because I died. It's sometimes it happens. We get bad weather here. But anyway, got quite a lot to get to this week. What are we talking about this week? We got some Ratesetter news. We're going to be talking about IFISAs this week. I know last week I promised to talk about IFISAs, specifically within peer-to-peer, and also we can talk a little bit about IFISAs, stocks and shares IFISAs, what you can do to distribute that IFISA money in an effective way. And we got some Lendy news, a little bit of Loanpad update. Obviously, we're going to talk about the Metro Bank acquisition of Ratesetter, some Growth Street news, some Crowdproperty news, definitely Lendy information, and if we have time, I'm going to talk about the profitability of peer-to-peer lending platforms themselves, which ones are actually looking like they might be able to make a profit and which ones are not. Might have to do that next week, though it depends how long it takes to get through this. And as always, please hit that thumbs up button, hit that subscribe button, show support for the Financial Thing channel. And just the thumbs up helps with the search algorithm. And as usual, I should do my disclaimer. This information is not financial advice and has not been prepared. I always get this wrong every week. This information is not financial advice and has been prepared without taking your objectives, financial situation, or needs into account. You should consider its appropriateness for your circumstances. All investments carry risk. Opinions in this stream are opinions based on my own personal experience. The FSCS does not cover peer-to-peer lending and your capital is at risk. Please don't invest more than you can afford to lose. And don't forget to diversify your investments, whatever you're investing in, especially if you're not that experienced. So quick hello to everybody in the stream. Hi, Norman. Alan, you are early today, but not early enough to be first in Basingstoke. Colin, the Peak District. Vince in Surrey from Leatherhead. Paul New from Manchester. Hi, Paul. Annabelle, good to see you as always in Dorset. Paul, a cracking autumn day in Kenilworth. Dale in Bristol. ES from rainy Portugal. Dave Dawson from Stoke. Paddy Gilfillan. I don't know where you are, but I'm presuming somewhere, maybe an island, but that would be totally stereotypical. And maybe you're in London, who knows? Hi, Aki chap from Accrington. John from Nottingham. Mike, hi, nice to see you, Mike Powell from the Action Group, Lendy Action Group represented. Thank you, Mike, for all that you do. Paul, hi, Paul Stetson, nice to see you. Tony from Somerset. Keith from Lincoln. Brian and Woburn, as always. Archer Atkinson. Mr. Chickaboy, nice to see you. As always, Folkestone and Darren. Chimpo, Naughty, probably one of the most interesting usernames that we have here on the stream. Thank you for joining us. So we're going to get right to this week's information. If you have comments or questions about what's going on with your own peer-to-peer lending situations or portfolios, or questions about the particular companies you want to get an opinion on, I'm happy to do that. Just pop them in the comments. As always, first off, Loanpad, as always, looks to be the slow and steady horse in the peer-to-peer lending race at the moment. They've increased their loan book by about £500,000 since last week. Average loan to value has gone up a little bit, but nothing untoward there. Still seeing a very low 28%. 7 loans have been extended, up from 5 last week, with 3 overdue and 1 currently defaulted. £14,500 of interest currently being serviced by the £40,000 interest coverage fund, which is Loanpad's version of the interest provision fund. So obviously we've seen that interest on the provision fund go up a little bit. That's been serviced. I think last week it was about 11,500. So I'm not too concerned about that. Again, there is a £40,000 fund, so couple of grand increase since last week, 3 grand. Not really concerned. Loanpad, just again, slow and steady. Really not have much assets capital news this week. The discount's still remaining on the access accounts. It's kind of ranging from 8 to 9.5%. I looked this morning, it was still at 8%. So if you're a happy assets capital investor, you can pick up some continued discounted loans on assets. Personally, I'm not a buyer at the moment. That's just me. Preferring to distribute, diversify. But if you like assets, you can definitely pick up some good loans at a great discount. So we'll talk about Ratesetter this week. News: the Metro Bank has completed its Ratesetter acquisition. No real surprises there. They put out a press release on their blog. They say Ratesetter investors will continue to fund the ongoing essential secured residential property development, dealer finance, family finance, and gift gaff lending. What does that mean for you as an investor? Well, it means what happens is Metro Bank is going to fund all of the unsecured lending, which last time I checked was about 80% of Ratesetter's portfolio. And now if you continue to invest through Ratesetter, your money is going to go to the secured lending, which would involve residential property development, the dealer finance, the family finance, and the gift gaff lending. Personally, what that seems to me is that even though all Ratesetter consumers and lenders are being covered by this provision fund all as one, if you were to break it down, you could actually say, well, retail peer-to-peer lenders are now going to be taking on those secured property lending deals. Well, that's where your money is going to go. But as long as Ratesetter's provision fund continues to be the model of the business to cover all of the lenders equally, not so much of a problem. Where it does become a problem is if the business model changes and coverage then is not continued to be equal by the provision fund, or if the provision fund were to run out or become in trouble like it did earlier when COVID hit and they reduced the interest rates. Ratesetter could theoretically change the way that secured lenders are covered and the way the unsecured, the bank, is covered. If you're talking about the rates the Ratesetter are offering right now, maximum of 2%, to be involved in secured lending at 2% is kind of a little bit of a head scratcher if you to think about it. I don't think any of us would necessarily invest in secured lending at 2%. Even we're talking about Loanpad, which is probably going to be about the lowest in the industry range of 3%. But if you think about Loanpad, you're talking about these loan to values that are in the low 30s, high 20% range, which means tons of risk has been taken off the table, especially since Loanpad is set up a different way to Ratesetter in the way that they do their underwriting. Now, as a retail peer-to-peer lender, if I'm a new investor, I'm putting my money in, and I know my money is going into purely secured lending at this point, I'm less likely to be enticed again by those rates the way they sit now. If you're going in at access at 1.5% to lend money against secured loans. I mean, it's not very appealing. Hence, I kind of figured that this would happen in the future. We had a announcement that Ratesetter is discontinuing their legacy product, which is the 5-year. Again, no surprise. When I visited Ratesetter, I think it was January 2019, maybe even before that, they said when they introduced these new Plus and Max products, that likely what would happen is the 5-year, 1 year would disappear eventually. It's going to be too complicated having these different products that are essentially doing the same thing. So the 5-year is going to be discontinued in October the 14th. What that means is any money that you had sitting in your holding account, I believe to be true. I didn't get the email, by the way, because I'm not invested in the 5-year product anymore. I exited out last week, got 100% exit out of the 5-year product. But what I believe is going to happen is if you have money in the holding account that was designated to go into 5-year lending, and after October the 14th, it won't get lent out, or any money that's paid back that you haven't designated to go anywhere except for the 5-year reinvestment, it's going to be sitting in your holding account, and then you can choose whether you want to withdraw it or to reinvest it into the Plus, Max, or the Access products. I think I've gotten about 60 or 75% of my money out of Ratesetter at this point, and until they put their rates back up, I really don't have much interest in going back in to Ratesetter at the moment. I think that the Metro Bank takeover is going to give Ratesetter a lot of financial boost that maybe it needed. I don't know what kind of financial situation they were in, but obviously they were looking for a buyer for a reason. And this Metro Bank deal now is completed, and that should give some confidence to people that are invested in Ratesetter, who's a little bit worried about what was going to happen to the company. So going back to the acquisition and the press release on the blog, Ratesetter said, apart from the remaining essential lending, the investor portfolio will go into runoff. This means the investor loan portfolio will decrease in size over time, but our focus on investment performance will remain throughout. Please note that with all unsecured lending being funded by Metro Bank, the weighting of investor loan portfolio towards secure lending will increase. Again, I said this last week, what I believe is going to happen, that Ratesetter will eventually cease retail peer-to-peer lending completely. And they're going to be one of the big three that no longer lends retail, and they'll become completely institutional. Now, if you're trying to exit this week, which I, again, exited last week, it took about a month and a half to get out of the 5-year product, so it was very quick. I can't speak for the Plus and the Max because I don't have money invested in there, but they seem to be releasing a good amount of money. They've released £8.5 million in September so far, so exit has been moving well. If you're trying to get out of the Access account, what you're seeing is very, very slow movement. I went up about 50 places between last week and now. I was at 185 position on the Access last week, now 131. So it is moving. It's just kind of trickling through. That's, again, an Access that has been requested RYI, release your investment, back in March 2020. So you can see 6 months down the line, still, probably a couple of months from being able to exit out of the Access account. And I think with this announcement that the 5-year is going to be ending, you might see, if you're trying to get out of the 5-year or you decide you want to exit, I would recommend probably doing that now, because if you wait towards the mid-October date, you might find that it's just not long enough for you to exit out. But I think you could probably get out within a month now if you want to, or you could just let your loans run off. I don't think that's a bad idea if you don't want to take the exit fee that you're going to have to pay. So there's still some unknowns about that, how that's going to work. I think ES just sent me the email on assets. Here we go. Yeah, she did. Let's see, close from that. So we're writing to give you notice the 14th of October, the 5-year market will close. From that date, investors will no longer be able to make new investments or reinvestments in the 5-year. Yep, knew that. Existing investments in the 5-year will continue to return capital interest. At the same time, we're announcing that we're restoring access to the 1-year market. So there you go. You can move from the 5-year to the 1-year. Don't know why you'd really want to do that because the rates are, well, let's see, market rate 4.8%. Okay, so maybe you would want to do that. Or you could just let your 5-year run out. You know, a lot of the investments in the 5-year product were pretty high interest rates. So that's why I'd be inclined to just let your investments run off in the 5-year product. Let's see what else. Does it say? They're asking that you don't make a run on the money because a lot of people try to exit at once. That will create a problem. Doesn't really say. Oh, here we go. I have an investment release request pending. What happens to it? Investment release requests in the 5-year market will continue to be processed until the 14th of October chronologically. Following that date, the investment release functionality will close in the 5-year market as communicated under 14.3 of the investor terms. At that point, all 5-year investment requests releases will be canceled and investors will receive payments of capital interest in line with the loan schedule. So yeah, if you don't exit before the 14th or your exit request doesn't get processed, you're going to be stuck in the 5-year product until your loan book basically runs off. So yeah, there you go. You're really taking a gamble too that Ratesetter decides to increase their rates at some point again. I mean, if they continue keeping them low till mid next year, maybe that's a reason to exit out. That was why I exited out. I didn't see any movement in the interest rates for a while. You're definitely not going to see a rise in interest rates. I mean, the Bank of England had said they're going to keep the rates low for a while. I think you could see low interest rates for the next 5 years. So, yeah. So if you have an ISA in the 5-year market, says as ISA transfers out must be in cash, the balance will need to be paid into your holding account before it can be transferred out. It's important that an ISA is transferred and not withdrawn, otherwise you'll lose the tax-free status. I'm presuming you would need the entire thing to be paid to you before you can get out. So partial transfer of an ISA possible. Yeah, a lot of unknowns, I think, still with Ratesetter. If I knew what was going on with their interest and they were going to increase it, then maybe there'll be something to stick in. But right now we don't know that. There's no word about that. There's no projections on interest rate increases, but at 2% in the max. Yeah, it's not really of interest. So, but the acquisition is done, and that's one positive thing. So there you go. What else do we have? So we have a loan on Grove Street seems to be continuing to be reduced, even though you've seen a definite slowdown. I think there was 66 loans on the books last time I checked. I think it was a month ago, and they released their new statistics with 58 loans now outstanding. So they're still having a lot of the borrowers that haven't been able to repay back their loans. I was looking at their statistics. One thing that did concern me with Grove Street is 23 of their loans are in the business services sector, which I honestly thought they might have paid out, been paid back some of those by now, a little bit more, but they still have 23. Business services is professional, scientific, and technical services, administration and support services, renting and leasing activities. Usually that type of business, you have securities on things like chattel, which, how much money are you going to get for a desk if it gets sold, or office furnishings. That's why the expected default rate on those 23 loans is about 10%. I mean, not the end of the world. You're talking about a little bit over 2 loans projected to default out of the 23. They still got 58 loans that are outstanding, so you may see that payback is a little bit slower now going forward. Again, just my opinion, don't know for sure. Average default rate, they're looking about 6.5%, and average available facility of the entire loan book of 58 loans is 148,837 pounds, with 115,084 pounds being outstanding. So, a good portion of the 148 average loan facility still being outstanding, but Grove Street hopefully is working hard for investors to get that repaid. Hopefully we'll see some more trickle payments like we've had. Let's look at Crowdproperty. They've had pretty good repayments on investor loans, borrower lending since COVID lockdown began. They've had about 10 million pounds repaid, and they seem to really have tightened down their credit criteria to lend. They've only approved about 3% of all the lending applications that have come across their desk, which means they're being very careful about what they're lending to. I've been happy with Crowdproperty so far. I've only been invested with them since June, and still early days, but on their statistics, they've had 91.1 million invested by lenders like yourself and me, and 46 million pounds have been repaid. So good results so far. If they're able to continue to do that through this COVID situation, then kudos to them for having a good business model that works, especially in peer-to-peer. So we had a Lendy. Oh, that was my piece of good news for this week. Sometimes I think I tend to bring the bad news with peer-to-peer because we've had a lot of bad news, but my 2 pieces of good news so far: Assets Capital is still operating well, Loanpad is still doing well, and Crowdproperty is paying back people. Cufflink is still on my top 5, so good pieces of good news. And Unbolted, I still continue to see those defaulted repayment emails that come in all the time about when they take something into default, and they're able to liquidate it very quickly. There was a question on the forum this week, on the Financial Thing forum on Facebook, the group, sorry, not a forum. If you want to join, by the way, I'll do my little announcements. If you want to join the Facebook group, go ahead and join up here. We have over 200, I think 215 members right now. So we talk about investing on that group. And also, by the way, join again the Lendy Action Group. Mr. Mike Powell is here from the Action Group. He provides a ton of great information on that. And then we have the Funding Secure Action Group with Mark Mason. So go ahead and join those, please. Cufflink seems to be handling their defaults while they take swift action. Those guys, they really don't like to let things get too far behind. If they have a problem with the loan, they really get on top of it. And I do like that about Cufflink, so they seem to be performing well. What else? So Lendy, this week there was a news story on Peer-to-Peer Finance News about The FCA, which is under fire because they seem to have missed crucial signs that something was amiss at Lendy before the platform collapsed. And this is what investors are claiming. Members of the Lendy Action Group have shared their anger at the regulatory body of the FCA after they learned the FCA was aware of alleged self-dealing and mis-selling at the peer-to-peer property lending platform. Throughout Lendy's life cycle, they consistently changed their terms and conditions. Lisa Taylor, a spokesperson for the Lendy Action Group, said people were making investments based on one set of rules, and then Lendy would go back and change the rules and apply them retrospectively. And yeah, this is going to end up in court. Essentially, what happened was before Lendy went bankrupt or out of business, closed their doors, they changed their terms and conditions to have this waterfall feature where they could get themselves a nice little chunk of the pie on any default recovery loans. And thankfully, lenders pulled together some money to hire a legal team to represent them against having this money be given to Lendy. So this is what the news article is about. The article said before the platform went into administration, Lendy made a dramatic change to the terms and conditions regarding the way that people would get paid in the event of a wind down, according to Lisa Taylor. Aside from the fact that Lendy should not have been able to change the rules retrospectively, the net effect was that Lendy's closure put into effect a waterfall that would strip as much as half of the anticipated cash recoveries before it went to the investors. The Lendy Action Group believes that when the FCA was made aware of that fact, the FCA mandated Lendy make restitution to investors that were impacted. However, Lendy was allowed to select which investors were eligible for repayment, blah, 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 saying Lendy got to pick and choose, and Lendy also made them sign a confidentiality agreement if they were to get paid, and that confidentiality agreement kept basically that fraudulent information away from other investors. The FCA should have known that Lendy had proposed terms within their notes that said Lendy was going to collect penalty interest payments in violation of the regulations. Earlier this year, Damien Webb, lead administrator RSM, who was the administrator for the Lendy wind-down, told Peer-to-Peer Finance News that he supports the Lendy Action Group's attempts to gain legal clarity on the position of investors, but warned that the legal costs could become very high. I think Mr. Webb, all due respect to him, he didn't know that there was these fraudulent things that had gone on in the background when he made such a statement. And I think now he'd probably have a little bit of a different take on that. It is a shame that the legal costs are going to be expensive, but if you don't stand up and fight sometimes for the rights of the investors, then other companies are going to know that it's okay to do this. And there's definitely a strong whiff of fraud poo in the air on this Lendy situation. Let's hope that for once the courts do the right thing and that money doesn't go into the pockets of Liam Brooke and Lendy, because there's absolutely no way they should get a penny out of this due to what's happened. So, yeah. What else do we have today? I want to talk a little bit about in the financial group, Facebook group, somebody had asked a question about if Ablrate or Unbolted had been recommended. And I just wanted to say that I think I'm personally pretty cautious about Ablrate. To speak candidly, I do like David Bradley Ward over there. I've said that before, but I do want you to understand the risks of Ablrate and what you're doing. You're getting paid high interest rates on your loans. There is risk, and some of the assets that secure these loans are tricky if they get called into default. I'm sitting on a single loan myself inside of Ablrate that was written in January of 2016, and it has been going through the court process for several years now. We're 4.5 years into that loan, and we have no resolution because the borrower is being a complete pain in the bum. And it's complicated security that apparently we don't know what's going on with it. So yeah, there are risks involved. And if you are going to chase high interest rates in peer-to-peer lending, you better be sure to know that if things, in loans default, they can be very complicated, But yeah, that's how I wanted to talk a little bit about, let's see here, currency fluctuations on tracker funds. I know I've talked a lot about the US equity index tracker that I really like investing in. I got an email this week from Paul, who was sitting in the stream asking me about, I think I got that right. If I've completely messed this up, if it wasn't you, Paul, then I apologize, but somebody had emailed me about currency fluctuations. And Vanguard has a really great article about currency fluctuations, and currency does play a part into when you buy a US equity fund, because basically Vanguard in the UK is going to take your money, they're going to exchange it into US dollars, they're going to buy the US equity fund for you. If you decide you want to sell that fund, they're going to go ahead and liquidate it, then change your money back from US dollar to sterling. So you do have some currency fluctuation risk. Now, however, if you're a long-term investor like me, over the long period of time, there's going to be benefits and disadvantages to this currency exchanging situation. But what happens is when the pound is weak, which it is now, your US equity index tracker is going to do better. When your money is exchanged into US dollar, you're going to get a better exchange rate. And they have some interesting return statistics on how the S&P 500 is returned in US dollar versus the total return in UK currency. And there's been some years, for instance, in 2014, the US dollar return was 13.7%, but in the UK, pound sterling return was 20.8%. And then you had years where, for instance, 2013, where the US dollar return was 32.4%, the British pound return equivalent was 29.9%, and then 2017, the US dollar return 21.8%, and the pound 11.3%. So you just see this kind of movement like that, where hopefully over the long period of time, it should even out. But over the last few years, you've seen the U.S. equity fund actually do better in U.S. dollar than it would in the U.K. equivalent, which is better for you as an investor. And Vanguard has written in this article that since 2004, sterling investors in U.S. equities have enjoyed cumulative gains about 30% higher than their U.S. dollar counterparts. So if you are a US dollar investor in the US, you're going to be 30% lower than sterling investors have done on these trackers since, well, not on the tracker, but just in the US fund, S&P 500 fund, since 2004. Now, obviously, if you're doing short-term investing, you're moving in and out of your index trackers, you are susceptible to those currency movements. But over the long run, personally, like I put money in every month, so over the long run, you're going to see those fluctuations in currency rates. And some of that does have to do with market timing. If you happen to sell out when the pound was strong and the dollar was weak, you would benefit from that exchange rate fluctuation. So I hope that makes sense anyway. Also, a little bit about ISAs. There's a lot of confusion with the ISAs, how these ISAs work. And you can have, we have a thing called a IFISA. You can have a stocks and share ISA. You can have a cash ISA. So you got three different types of ISAs. We have inside of peer-to-peer, we use the IFISA. And as long as you don't go over £20,000 in your current year allocation, you can split that £20,000 up any way that you want in between those three. So you could put 5 in the IFISA, which is, by the way, Innovative Finance ISA. You could put 10,000 in the stocks and shares ISA and 5,000 in the cash, or whatever combination of splitting that 20,000 up, as long as you don't go over the 20 for that current year. What you're able to do is open up one ISA in the peer-to-peer lending space or alternative finance. You can open up one ISA in the stocks and shares, one ISA in the cash. What you can't do is open 5 different ISAs in the peer-to-peer lending. You couldn't open 5 different peer-to-peer lending accounts and then split your money up. And this is one of the good things about taking old ISA money. If you've got old ISA money from previous years, say you've got 20,000 from 2017, you can take that 20 grand and split it up into as many places as you want. If you wanted to put it in 10 different peer-to-peer lending companies that year, if it was your 2017 money, you can do that, which is what I would recommend doing, and not putting 20K into one company. If, let's say, you want to put in your ISA allocation for this year, your IFISA, I would say put a little bit into peer-to-peer, put a little bit into the stocks and shares, put a bit into the cash, or take your last year's ISA money or previous years and diversify that. It's the one thing that I don't really like about the current rules of the ISA, how you can split it for the current year. I think you should be able to pretty much do whatever you want. It's probably something to do with the administration, how it works. It's a pain if you're splitting up existing current years into lots of different places. So the government doesn't allow it. By the way, if you are moving an ISA from previous years, let's say you have a stocks and shares ISA with Lansdowne, Hargreaves Lansdowne, or Charles Stanley, and you want to move that to, say, Vanguard, all of your funds inside of, say, Charles Stanley are going to have to be liquidated into cash before you can transfer the ISA to, say, Vanguard or Fidelity. You won't be able to take what you have, your existing investments in there, and move them over. So if you own Shell shares in your Charles Stanley ISA and you wanted to move it to Fidelity, you wouldn't be able to do that. They'd have to be liquidated, and then the cash would be moved over. There's a lot of confusion about that. I think a lot of people have gotten it wrong. I know some of my readers have had to go back and redo their ISAs because they opened up incorrectly a couple of different ISAs in the same sector for the current year. So I'm going to write an article and put that up on Financial Thing about how to do that correctly in the future, just to kind of like make it a little bit clearer. Other news, FCA is conducting a consultation right now about capping these limits of what people can apply for within the complaints department, and they're going to extend this consultation for another few weeks because there's just not enough time for them to do this consultation correctly with what's happened with COVID. So some of the MPs have said, oi, you need to look at this a little bit longer. So who knows what the FCA will do with their consultation, but anyway. And as far as interest rates go, again, we've seen Bank of England 0.1% interest rates. And interestingly, we saw Ford Bank this week. I got an email saying they were putting their interest rate up, which I was surprised. I couldn't believe it. It's only going up 0.5% from 0.7% to 0.75%. But I was really expecting to see more cuts in that department. But I think you're going to expect to see interest rates low for the next 3 to 5 years. Inflation right now in the UK is at 0.2%. It's supposed to be at about 2%. That's the Bank of England's target. So way, way under that. Until that inflation rate starts to rise, you're just not going to see any increases in interest rates, which is why you do have to look at peer-to-peer lending as a way to be able to get some kind of yield now, because you're not going to get it from the banks, that's for sure. You're not going to get it from any bonds. Maybe premium bonds is something to look at now because maybe you can eke out a point and a half percent on premium bonds. Never been a fan myself. I'd rather take that money, bang it into the stock market, or a little bit of peer-to-peer. So we saw Starling Bank this week also talk about a negative interest rate situation on euro accounts. They're the first bank to introduce that. It was kind of a minor thing. It was for their euro-based accounts over 50,000 euros. And so 0.15% fee on any balances over 50,000 euros, which is the equivalent of about 5 euros on every 1,000 euros over 50. So if you had 51,000, you'd be paying about 5 euros in fees for Starling Bank to store your money for you. So you are seeing that. I don't think that they're going to be the last bank that will start charging people to store money. With these rates the way they are, I think that's going to be sort of a commonplace thing. And can you imagine having to pay the bank to store your cash? It would be an interesting situation. So what else? Anything else interesting? I'm just going to take a look at your comments. See if you have any questions, pop them in. Please hit that thumbs up. We got trying to look through my tripod. 42 people on the stream, 33 thumbs up. Thank you very much to everybody who's hit the thumbs up. It helps me with the YouTube algorithm. Norman says, what's happening with Wellesley? No interest this month. I got to tell you, I'm not a Wellesley fan. I withdrew from them years ago, and they've really been off the radar for me for a long time. So don't know what's going on at Wellesley. They just don't come across the radar at all. I don't get asked too much about them on the email, so I never really look, but I will take a look. I'll see if next week I can see what's going on with Wellesley. Let me put a little note in my notes here. Look at Wellesley. Okay. Hey, Ken in the island, how are you today? John said, no IFISA scream jokes. Ice cream. Ah, yes. Nice to see you, John. Cheesecake. Aki Chap, you're eating cheesecake and hobnobs. You must get a lot of exercise to get rid of all that food that you eat. Martin, hi, Martin in Leeds. Nice to see you. You put a quote up here. It says, an investment in knowledge pays the best interest. That's good. That's why we're here. Paul, Patty, Apropos Metro. Ratesetter investors have been ditched and disregarded, and that's Metro have taken the helm. They'll steer the ship to all 4 points of the compass. Ratesetter investors are now puppets on a string. Yeah, whenever a bank takes over a peer-to-peer company and now becomes institutional, you are going to see some changes. Peer-to-peer companies, they can change the way that they do things anytime too. So unfortunately, there is no being locked into anything. It's like when you put your money into a bank savings rate account, the bank can change their savings rate on you at any time. Unfortunately, it's what you sign up for as an investor. I would say if we look at it on a positive note, that worst case scenario, Ratesetter were to go out of business would be a lot worse than Metro coming in and saying, we're going to wind down retail peer-to-peer lending. I would rather see investors' capital repaid. We've seen some bad outcomes in peer-to-peer from companies that have not done the right thing. But yeah, ultimately Metro is going to do what's best for shareholders, and they're in the business to make a profit, as is every bank. I'm not a fan of the banks. I think they tend to rob people just in a very corporate way. They're paying you 1% or less on your money, sometimes as low as 0.1%. They're taking your money and lending it out. It's kind of robbery. So, Patty, yeah. Paul News says, what do you think about the new lockdowns, potential full lockdown soon? This could have a big impact. The mortality rate still going down, yet this is very odd. I think, Paul, it's tough, you know. I mean, my human empathy side says lockdown, keep people safe, but how much financial damage you're going to do to an economy to save a small, very, very small percentage of human life. And the mortality rate obviously is differing from country to country, but at what price do you pay locking down entire countries, you know, for months and months? You're actually going to destroy the economy. And I think it looks like vaccines are not close. God, it's tough. It's tough. I mean, as an impacted business owner myself, because my business has been severely impacted due to COVID. I want the economy to be open, but I also have an elderly mother, you know, who is 84 years old, and she contracts something like corona, is probably not going to be good for her. So there is that. Two different sides of the coin. I don't know what the right answer is. I'm not sure that you're going to get rid of this virus. It's obvious that the country has been in lockdown for a while, and the virus isn't going away. Maybe a vaccine is the solution. I don't know. Maybe it's not. I mean, things have been eradicated by vaccines. It's like polio, tuberculosis has been vaccines. I had a vaccine when I was a kid for that, and it eradicated mainly the problem, especially polio. What damage is it doing to the human body? I don't know. You know, that's again, it's a question up for debate. But we'll see what happens. We will see what happens. Thank you, ES, for forwarding the Ratesetter email. I appreciate that. Could you explain what the Ratesetter gift gaff lending is? I can when I look it up. I don't know. Maybe somebody else knows. Let me see if I can find it. I'm not all knowledgeable on Ratesetter's gift gaff lending. Oh, so gift gaff does peer-to-peer lending. Who knew? I didn't even know that myself. I should. So giftgaff has a partnership with Ratesetter to provide